Why most get-rich-quick strategies fail, and what actually works. Every cycle, it's the same story. New strategy. New platform, new promise. Anyone can do this. Low risk, high reward. Just follow the steps. I made $10,000 in my sleep. This new crypto coin is going to the moon. Quit your job and start dropshipping today. We've all seen the ads. They promise a lifestyle of luxury with almost zero effort. But have you ever noticed that the person telling you how easy it is to get rich is usually making their money by telling you how easy it is to get rich? And every time, a small group wins big, a large group loses quietly, and most people are left wondering what they did wrong. Today we're going to talk about why most get-rich-quick strategies fail, not in theory, but in reality. We're going to expose why the most hype get-rich-quick schemes almost always end in a get-broke-fast reality, and I'm going to show you the boring, unsexy, but 100% effective framework that actually works and builds wealth instead. Because the truth is, it's not that fast money is impossible. It's that most people don't understand how risk, leverage, and timing actually work. 1. The core problem with get-rich-quick. Let's start with the uncomfortable truth. Most get-rich-quick strategies don't fail because they're scams. They fail because they only work under very specific conditions. Conditions like perfect timing, access to information early, capital you can afford to lose, emotional discipline most people don't have. What people see is the outcome. What they don't see is the setup. When you join late, undercapitalized, and emotionally invested, the math turns against you. That's not bad luck, that's structure. 2. Dropshipping. Why it looked easy, and why it broke people. Dropshipping is a perfect example. The pitch: find a product on AliExpress, run some Facebook ads, and collect the profit. It did work for early adopters, people with strong marketing skills, those who understood supply chains and margins. Now in 2026, the reality is copy-paste stores flooded the market, platforms, and the market is hyper-saturated. Between rising ad costs, shipping delays, and 2% profit margins, most beginners lose their entire initial investment before they make a single sale. Most people entered when competition was brutal, margins were thin, refunds and chargebacks were common. The real case is thousands of people spent money on ads, suppliers, and courses only to realize they were running a business with no moat, no brand, no control. The few who succeeded didn't get rich quick. They built brands, optimized logistics, and reinvested profits. The rest chased speed and paid for it. 3. Crypto moonshots. When timing beats skill, crypto didn't break people. Human psychology did. The pitch: find the next Pepe or Doge before it explodes. Early investors who bought before hype understood the tech, took profits, made life-changing money. The reality: this isn't investing, it's gambling. For every one person who turned $500 into $1 million, 10,000 people provided the liquidity for that person to exit. Late entrants? They bought narratives, not assets. They held through volatility they didn't understand, listened to influencers who already exited, and confused belief with strategy. Real pattern: early money equals asymmetrical upside, late money equals exit liquidity. Crypto can work, but only if it's a small portion of your capital. You understand cycles, you don't need it to succeed. Most people needed it to work. That's where it fell apart. 4. High leverage trading. The illusion of control. Leverage trading is seductive. Small account, big gains, fast results. The pitch: use 100x leverage to turn a small price move into a massive gain. The reality: leverage magnifies mistakes faster than skill. A 1% move in the wrong direction wipes out your entire account. It is mathematically designed to favor the house, the exchange, not you. Professional traders use strict risk management, have emotional detachment, trade probabilities, not hope. Retail traders? They overtrade, revenge trade, increase size after losses. Real cases show this clearly. A few disciplined traders build slow, steady equity curves. Most accounts get wiped, not by one bad trade, but by compounding emotional decisions. The market doesn't reward excitement, it rewards consistency. Why do these fail? It comes down to two things: asymmetric risk and the low barrier to entry. If something is easy to start, everyone does it. When everyone does it, the profit disappears. Case study: the 2021 NFT crash. Remember the Bored Ape era? People were investing life savings into JPEGs. When the hype died, the liquidity evaporated. Real story. A UK investor famously spent $300,000 on a rare digital asset, only to see the highest bid drop to $10 within a year. He didn't lose because he was unlucky. He lost because the asset had no intrinsic value beyond the hype. 5. The pattern you're meant to notice. Here's what all failed get-rich-quick attempts have in common. They rely on timing instead of structure. They require constant attention. They lack downside protection. They depend on optimism, not systems. The strategies themselves weren't evil. They were just misunderstood. 6. What actually works? Sustainable wealth frameworks. If those don't work, what does? Sustainable wealth is built on a simple formula. Value coupled with scalability and time is what grows true wealth. Now let's talk about what actually works. Not fast. Not flashy, but repeatable. Framework 1. Skill gives leverage, gives scale. Let's talk about high-value skill acquisition. Instead of chasing a tactic, build a skill that businesses are desperate for. AI implementation, high-end sales, or specialized engineering. A tactic can be patched or saturated. A skill belongs to you. Build a skill that solves real problems, can be sold repeatedly, improves with time. Then, add systems, add automation, add distribution. This creates nonlinear growth. Framework 2. Building assets, not just income. Income pays bills. Ownership builds wealth. Wealthy people don't trade time for money indefinitely. They build systems, content assets, software, SaaS businesses, IP platforms, real estate. These appreciate while you sleep. Case study, the slow millionaire. Look at creators like Ali Abdaal or entrepreneurs like Alex Hormozi. They didn't get rich in a week. They spent years building a brand and a skill set before the explosion happened. That's the overnight success that took 10 years to build. Framework 3. Asymmetric risk. Risk small amounts for potentially large upside. Not all in, but small bets, many times. Framework 4. Long-term positioning. Wealth comes from positioning before demand explodes, not chasing it after. The people who win quietly, enter early, build patiently, exit strategically. The real truth, the mindset shift. The hardest part of getting rich is that it usually takes a long time. Most people don't fail because they're lazy. They fail because they're taught to chase speed instead of structure. The get-rich-quick industry preys on your impatience. Get-rich-quick sells hope, but systems build wealth. The next time you see someone flashing a Rolex in a trading signal group, ask yourself, if this works so well, why do they need my $99 for a course? Stop looking for the shortcut. Start building the foundation. And the irony is, the strategies that look boring at first are usually the ones that work. If you stop chasing the shortcut and start building leverage, you don't just make money. You keep it. If you want to see exactly how to choose a high-value skill to start your journey, check out more videos on the channel. If this video helped you see the game more clearly, subscribe. This channel is about truth, not hype. And in the long run, truth compounds.